There's something happening in the gold market right now that most people don't see. It's not dramatic, it's not sudden, but it's structural and it's important. The gap we're talking about is between the gold price you see quoted everywhere and the reality of what's actually happening when people try to get physical gold delivered. This gap is widening, and it's telling us something important about money, confidence, and how the financial system is shifting. Let me explain what's really going on, because understanding this changes how you see inflation, savings, and the stability of the system itself. The story starts with a simple observation. If gold prices are at current levels, why is it so difficult to actually get physical gold in your hands? That difficulty has a name. It's called a premium, and it's growing. Most people don't pay attention to premiums because they think of gold as a commodity with a single price. But in reality, there are two gold markets operating side by side. There's the paper gold market. This is where futures contracts trade, where ETFs operate, where theoretical gold changes hands electronically. In this market, the gold price is what you see quoted, maybe $1,100 per ounce, or whatever the current spot price is. But then there's the physical gold market. This is where actual metal changes hands. And in the physical market, you don't just pay the spot price, you pay the spot price plus a premium. The premium is the extra cost above the quoted price that you have to pay to actually receive physical gold. Historically, this premium has been small, maybe a few dollars per ounce. That's normal market friction. But lately, these premiums have been rising, and they've been persistent. A rising premium tells you something specific. There's more demand for actual physical metal than the current supply can easily accommodate. When physical gold is abundant and easy to get, premiums disappear. Buyers can get it at a spot price. But when physical gold becomes harder to source, buyers have to pay extra to get it. That's what we're seeing right now. This is the gold reality gap, the gap between what the theoretical price says and what it actually costs to get the metal. Why does this matter? Because it signals that something structural is happening. It signals that the paper market and the physical market are starting to operate independently. The paper market says gold is one price, but the physical market says it's worth more. This separation has happened before in history. During the Great Depression, during the 1970s when the gold standard collapsed. Each time it happened, it was a signal that something in the monetary system was shifting. We're in a similar situation now, but this time it's gradual and structural, not sudden and dramatic. Central banks are moving from paper gold to physical gold. Institutions are doing the same. Wealthy individuals are doing the same. This creates steady pressure on physical supply. Demand is consistent. Supply is relatively fixed. Mining production hasn't increased significantly. In fact, mining output in many regions is declining. Recycling provides some new supply. But recycling is becoming more difficult as gold gets locked away in vaults around the world. So you have structural demand meeting constrained supply. That's the recipe for what we're seeing. Rising premiums, longer delivery times, a widening gap between paper price and physical reality. Delivery times have extended for some forms of physical gold. Coins, bars, allocated inventory. This used to happen in days or weeks. Now it can take weeks or months depending on the form and purity. This friction is real, and it's not temporary market congestion. It's structural tightness. The first signal of a structural shift in how the world values gold is exactly what we're seeing. Physical gold becoming harder to source at the quoted price. This is not a collapse signal. It's a reallocation signal. It's a signal that gold is transitioning from being treated as a tradable commodity to being treated as a reserve asset. When something shifts from commodity status to reserve asset status, the dynamics change. Supply constraints become more relevant. Long-term holding becomes more important. Price becomes less relevant than availability. This is what happened to oil when it became strategic. It's what happens to any asset when central banks and major institutions decide it's essential to their reserves. The gold reality gap is the first visible symptom of this transition. Understanding it helps you understand what's happening next. And what's happening next involves central banks. Let's talk about what central banks are actually doing right now, because their behavior is the key to understanding everything else. For 70 years, since the end of World War II, the US dollar has been the world's dominant reserve currency. That means most countries around the world hold their emergency reserves in dollars, not gold or other assets. This has been the foundation of the global monetary system. It's been stable, it's been predictable. But something started to change around 2022, and it's accelerating in 2026. Central banks around the world are buying gold, not selling, not trading, buying gold and holding it. China's central bank has been the most visible. They've been accumulating gold consistently for years. But China is not alone. Russia has been buying gold. India has been buying gold. Other countries are buying gold. This is what we're calling the reserve pivot, a gradual shift in how central banks construct their reserves. Instead of holding primarily dollars, they're diversifying into gold. Why would central banks do this if the dollar is still the dominant global currency? The answer involves understanding what's happening with global trade patterns. More countries are doing bilateral trade without using the US dollar as the intermediary. China and India are trading directly in their own currencies, not dollars. Russia and China are doing the same. Europe is trying to create payment systems that bypass the dollar. This is dollar-neutral trade that happens without the dollar being the medium of exchange. As more trade becomes dollar-neutral, countries need less dollars in their reserves. So they're diversifying into gold. Gold is the perfect reserve asset for this transition. Why? Because gold is neutral. It doesn't favor any country. It doesn't depend on any government's promise. Gold is gold. It has value in any currency system, in any monetary regime, in any political environment. So when a central bank buys gold instead of holding dollars, they're essentially saying, we want to hold something that will be valuable, regardless of which currency system wins globally. This is not a dramatic statement. It's not countries abandoning the dollar. That's too strong. But it is countries reducing their dependence on dollars. And that's significant. It's a structural shift in reserve composition. And it's happening across multiple central banks simultaneously. This is different from when individuals buy gold because they're worried about inflation. Central banks aren't primarily worried about inflation in the traditional sense. They're worried about systemic risk. They're worried about the dollar's future role in the financial system. They're hedging against changes to that role, against the possibility that the dollar's dominance declines over time. This creates a different kind of demand for gold, demand that's persistent, demand that's tied to long-term positioning, not short-term speculation, not inflation hedging, but reserve asset positioning. And that's why this demand is supporting gold prices in ways that are independent of inflation or other traditional factors. When China buys gold, they're not trading it next month. They're holding it for decades. That creates a steady floor under gold prices, a demand that doesn't go away. The central banks buying gold right now represent trillions of dollars of reserve assets potentially being reallocated away from dollars and toward gold. Even if this happens gradually, even if it takes years, the direction is clear. More gold going into central bank reserves, less reliance on dollars as the primary reserve. This is the reserve pivot, and it's the second signal of a structural shift in the global monetary system. The first signal was the gold reality gap, the widening spread between paper price and physical availability. The second signal is central bank behavior, the consistent accumulation of gold by countries around the world. Together, these two signals tell you something. The world is slowly but persistently moving toward a different monetary architecture. And understanding that helps you understand the third part of this story, which involves U.S. debt. Now we need to talk about something that affects everything: U.S. national debt and the interest rate situation. The United States has massive national debt, over $30 trillion. That debt is growing every year. The government spends more than it takes in. The difference becomes new debt. This isn't unique to America. Most developed countries have high debt levels. But America's situation is different because the dollar is the reserve currency. That gives the U.S. a special advantage in borrowing. The world wants dollars, so the world is willing to buy U.S. Treasury bonds. That keeps borrowing costs low. But that advantage only works if people keep wanting dollars and keep buying Treasury bonds. And here's where it gets complicated. The Federal Reserve is trying to fight inflation by keeping interest rates elevated. Higher interest rates are supposed to reduce spending and cool down inflation. But higher interest rates also make the government's existing debt more expensive to service. When you owe $30 trillion and interest rates go up, your annual interest payments skyrocket. This creates what's called the debt and interest rate trap. The government needs rates to be high to fight inflation. But high rates make the debt burden worse. The government needs rates to be low to manage the debt burden. But low rates don't fight inflation. You can't solve both problems at the same time. You have to choose which one matters more. This is where real interest rates become crucial. Real interest rates are the interest rate you're earning minus the inflation rate. If you earn 4% interest, but inflation is 3%, your real interest rate is 1%. You're earning a positive real return. Your wealth is growing in real terms. But if you earn 4% interest and inflation is 5%, your real interest rate is negative 1%. You're losing money in real terms. Your wealth is declining. For most of the last decade, real interest rates have been negative. Savers have been losing money in real terms. But borrowers have been winning. The government has been winning. You can owe money in dollars and pay it back with dollars that are worth less. This has been the situation the U.S. government has benefited from. But this only works if people believe inflation won't be persistent. If inflation expectations shift, if people think inflation will be sticky, they demand higher real interest rates. And that's where the trap tightens. Because higher real interest rates mean the debt becomes more expensive to service in real terms. This is the structural situation the U.S. is in. Massive debt, elevated inflation, interest rates stuck in the middle, can't go too high or the system breaks, can't go too low or inflation continues. This uncertainty is also why central banks are buying gold. They're looking at this situation and thinking about reserve assets that don't depend on the US government's ability to manage the debt-inflation balance. Gold is the insurance policy. Now let's talk about paper gold versus physical gold, because the uncertainty around US debt and interest rates makes this distinction more important. When you buy a gold futures contract or a gold ETF, you're not buying gold. You're buying a contract. You're buying a claim that if you want gold, you can take delivery or cash settle. But it's dependent on the counterparty honoring that claim. This is counterparty risk, the risk that the other party won't do what they promised. Historically, counterparty risk on gold contracts has been low. Major exchanges and institutions are reliable, but counterparty risk is never zero. There are always scenarios where it could matter. If a major financial institution faces stress, they might have difficulty honoring gold delivery claims, or if there's a run on physical gold, they might not have enough physical metal to deliver everyone who wants it. This happened to some extent during the 2008 financial crisis. Institutions couldn't deliver on gold claims. The fact that central banks are moving toward physical gold instead of paper gold suggests they're thinking about this risk. They'd rather own the actual thing than own a claim on the actual thing. During normal times, this doesn't matter. Paper and physical work together smoothly. But during stress scenarios, it matters a lot. The widening premium on physical gold relative to paper gold is the market pricing in this counterparty risk. It's saying physical gold is worth a premium over paper claims because it doesn't have counterparty risk. This is rational behavior, and it's happening right now. So we have the debt and interest rate trap limiting the Fed's policy options. We have uncertainty about whether real interest rates will be positive or negative long term. We have central banks moving from paper to physical gold. All of these are signals, and they're pointing in the same direction. Let's bring all of this together and talk about what it means from a wealth preservation perspective. Wealth preservation is different from wealth creation. It's not about getting rich, it's about maintaining what you have. Throughout history, gold has served as a wealth preservation asset. It holds its value through inflation, it holds its value through currency devaluation, it holds its value through political uncertainty. It's the asset that works across different monetary systems. But gold only preserves wealth if you actually own it. A gold certificate isn't preservation if the issuer goes out of business. This is why the shift from paper to physical is significant. People and institutions are moving toward direct ownership of actual assets instead of claims on those assets. This is a flight to tangibility, and it's happening right now in gold and other commodities. The reason is visible in what we've already discussed: uncertainty about debt, inflation, interest rates, and the reserve currency system. When those things are stable, people are happy to hold paper claims. It's convenient, it's liquid. But when uncertainty rises, people want to hold things that don't depend on anyone's promise. Gold is the classic example. But the same logic applies to real estate, land, and other tangible assets. A wealth preservation strategy in this environment typically includes some allocation to physical assets, assets that maintain purchasing power through inflation or currency changes. Gold is one option. Silver is another option with different characteristics. Silver versus gold. Gold is primarily for store of value. Silver has industrial uses too. So silver can be affected by economic cycles. Gold is more stable as a pure reserve asset. The percentage allocation to precious metals depends on your situation, timeline, and concerns. But the key insight is this: wealth preservation during a period of high debt, elevated inflation, and monetary system uncertainty requires thinking differently about security. Holding all your wealth in paper assets, bonds, stocks, bank accounts, means you're betting that institutions and governments managing those assets will function smoothly. That's not guaranteed. Holding some wealth in physical assets means you own something directly, something that doesn't depend on anyone's promise or performance. This is why central banks are buying gold. They're saying, we want to own something, not just hold a claim on something. This is why premiums on physical gold are rising. Individual and institutional investors are saying the same thing. This is a structural shift in how people think about asset allocation. For decades, diversification meant stocks, bonds, and maybe some gold. But when the foundation of the system itself, currency, debt, interest rates, is uncertain, the calculus changes. You want to own things that maintain value regardless of what happens to those foundations. Gold is valuable in an inflationary environment. Gold is valuable in a deflationary environment. Gold is valuable when currencies are strong. Gold is valuable when currencies are weak. It's the one asset that works across all scenarios because it doesn't depend on anyone's promise. The purchasing power of gold is stable in the long term. The nominal price fluctuates. But the amount of stuff you can buy with gold remains relatively consistent over decades. That's what wealth preservation means. That's why central banks hold gold. That's why individuals who are thinking long-term are accumulating gold. Now let's look at the big picture. What do all of these signals tell us? We have a gold reality gap, physical gold becoming harder to source at the quoted price. We have a reserve pivot, central banks diversifying away from dollars and into gold. We have a debt and interest rate trap, limiting the policy options available to the Federal Reserve. We have a shift from paper to physical, institutions and individuals preferring direct asset ownership. These are not coincidental. They're connected. They're all symptoms of the same underlying shift. The shift is this. The world is transitioning from a dollar-dominant monetary system to a more multipolar system where gold plays a larger role. This doesn't mean the dollar collapses. That's too dramatic. But it does mean the dollar's dominance declines gradually, and alternatives become more important. This transition will take years, maybe decades. It's not sudden. But it's structural, and it's already visible in the data. The gold price is rising not because of speculation. It's rising because central banks and institutions are reallocating reserves. The physical gold shortage is real. It's structural. It's not temporary. The debt situation in the US is real. It limits policy options. It creates uncertainty. All of these factors together point toward a world where tangible assets like gold are more important than they've been in decades. If you're thinking about your savings and your long-term wealth preservation, this matters. It doesn't necessarily mean you should buy gold. That's a personal decision based on your situation. But it does mean you should understand why gold is becoming more important in the global system. It means you should understand that the price you see quoted is not the same as the actual cost of getting physical gold. It means you should understand that central banks are positioning differently, and that positioning reflects their views about the future monetary system. It means you should understand that the debt and interest rate situation creates a long-term uncertainty about currency values and real returns. Understanding these structural shifts helps you make better decisions about your own financial situation. The gold reality gap, the reserve pivot, the debt and interest rate trap, the shift from paper to physical, these are all signals. They're telling a coherent story about where the world's financial system is headed. That story is about a gradual, structural shift in how value is stored and how risk is managed globally. It's not a story of collapse. It's not sensational. It's quiet and structural, but it's happening. And understanding it gives you an advantage in navigating the changes ahead.